Investor, today we're going to talk about the interim goal of $1,000 a month. I think I may have to update my goal to $1,500 a month because I've been so far. Last month I hit $1,643, and this month is not over yet, and I already hit $1,636 in option, mostly option premium with a sprinkle of high yield dividends, and I have some more trades on. So I may have to revisit and see if I can change it to $1,500 a month. What do you guys think? So far, my annualized return for this month is 28.3% return. There was a big move. Basically, I had a position in the S&P 500. I had a 512 covered call, which was executed, and my shares were called away. And I received $265 for this call. This is an old call that I kept rolling and rolling. I decided that I am tired of rolling it and I want to have my shares called away. And this way I could free up my capital to do other trades that are more lucrative. I understand that there's about a $6,000 gain, which will be a capital gains gain of $6,000. Because my cost basis was much lower than that, but I've held it over a year, so it should be long-term capital gains. And basically, I decided I'm okay with that. So that also has been sucking down my returns because my percent return, annualized return on my premium of my 100 shares of S&P 500 has been pretty dismal, especially with the rolling. So it's been sucking down my return. But as you can see, that overall for this month, my annualized return is 28 so far running, because I have more trades, at 28.3%. In May it was about 20%, April was 25%, and in March when I started was 18.53. So you could see that this month is a record annualized return for the month if you analyze it on a annualized basis, and the premium amount is the most. And again, this is not my buying power, it's much less than that. This is just revolving buying power when opening and closing trades. And speaking about trades that are currently open right now, I have one trade actually open, just one trade open right now. It's that same IWM that I got assigned at when I did the put at 202. That's my cost basis. So I basically opened up a new cover call, not daily because it didn't make any sense. So I just did a couple, like 5 days out, less than a week, mid next week. It's going to expire. And it was trading about $99 when I put on the trade. That's my cost basis. As I mentioned, it was a 0.24 delta. So I'm selling a cover call at my cost basis. Some YouTubers say, and some people claim, that if you get premium, you could reduce your cost basis. But in my mind, if you reduce your cost basis by the amount of premium that you receive, then you kind of wasted your time getting the premium, because I want to keep the premium. I don't want to use the premium to reduce my cost basis. I want to actually keep that premium to reinvest it. So I try to keep it at that cost basis. If I do want to truly reduce my cost basis, I may do something like a covered strangle, which could reduce my overall cost basis. A covered strangle is selling a covered call, and then if the stock falls too much that selling a covered call at your original cost basis doesn't give you any meaningful premium, you can start selling a cash secure put below what the market is. And once you get assigned that cash secure put, then your overall, now you own 200 shares, and now your average cost for the 200 shares is less, because you bought your second chunk of 200 shares is much lower than your initial 100 shares. So like a cover strangle is how I want to reduce my cost basis if that were to happen. So the premium I received was $50, and it's only an 18% annualized return, but that does meet that's acceptable in my books, although I'd like to get more, but that's so far. We'll wait and see what happens with the IWM. speaking of the covered strangle, because I still have some meaningful premium, I'm not ready to put on that next cash secure put. I would only consider putting it on if IWM were to fall too far down where I wouldn't be able to get any covered call money. So then I want to be back in the game, and I were to do that. I have a question for you guys. So speaking about poor man, I was thinking about doing a poor man cover call. I see a lot of people do poor man cover calls. So I was looking at, I don't know how people make it, like do a leap and then sell short call against it, because when you do a leap, initially you're paying for extrinsic value and intrinsic value. Intrinsic is the money below the strike price, the actual value of how far down you are below the strike price, and the extrinsic value is the time value that you have. And so I found this strategy over here. Let's say in IWM, I'm analyzing this move. I'm not sure if I will do it. It's a expiration of 12/18/26, which expires in about 2.5 years. The strike is a long call or a leap option that you would purchase for $100. Right now, after market, it looks like the premium is about 107 to be 107 and change. So let's say, for round numbers, we'll say it's 107 per share. If you multiply that by 100 shares, it's about $10,700. So you control 100 shares of IWM for the next 2.5 years if you want to keep it that long. And instead of buying 100 shares for about $20,000 or $19,900, close to $20,000, you get to buy for almost half the price. So you could almost double lever your power. The delta is a 0.99 delta. I know it's not a 0.8 delta like a lot of people say. The 0.8 delta was way, the break-even price would have been way, way more out of the money, because right now, if I were to go ahead with this trade, my cost basis or break-even price would be the $100 of the long call plus the 107 that I'm paying would be a total of 207. And right now, if it's trading around 199, 200, I'm only $7 out of the money, so I'd only be able to sell at the 207 strike price right now until, hopefully, if IWM would drift up, then I could sell closer. It'll be closer to my strike price. And the only thing I found that makes sense was weeklies as of now, if I were to do this trade. And then once IWM hopefully would drift up closer to 207, I could start trading dailies on it, or I could, at my cost basis at 207, or ideally even dailies above my cost basis, which would be the best scenario. And this way I'm only using 10,700 to control this 100 shares versus double. So I pretty much have like a double lever on that. But looking at where IWM is, of course some people don't believe in indicators. So here you have this this Bollinger Band. That's the opaque color. It looks like here's the top. Looks like the top is like 213. The bottom looks like it's about 170 over here in the bottom. So it looks like we're not at the top, but we're close to the top. It looks like at one point it stuck its head out above the top, and it kind of went back to almost like mean reversion, as some people call it. And then you have the 50-day moving average. It looks like the 50-day moving average is about 191. So if I'm going to put on a poor man cover call, putting up $10,700 at risk, God forbid if IWM will fall and stay low, you can lose that. So I'm happy that we're not at the top of the Bollinger Band, but we're close-ish to the top. But I'm also not too happy that we're above the 50-day moving average. So just some, you can use whatever technical analysis you do. It just gives me a little bit of guidance. I'm not saying this is the way to trade, but this is some stuff that I look into. These are things that I'm thinking about. So I'm thinking about it. It's tickling my thoughts. But we will see what will happen. Next week is a whole nother week. Like I said, I only have IWM on, so I have a big position in cash ready to decide where to deploy that, what kind of cover. Start with covered puts, and we'll take it from there. This is the One Investor for now.